Hey everyone, and welcome back. Today, we have to talk about silver. For years, silver was called the poor man's gold, but lately, its price action has been anything but poor. We are seeing incredible surges, prices breaching that psychological $100 an ounce mark, and the question on everyone's mind is, are we in a speculative bubble? Is this just FOMO driving things up? Well, the answer, based on the market mechanics right now, is a resounding no. This isn't just speculation. This is a profound structural change in how the silver market fundamentally operates. To understand this, let's look at gold first. Gold has had a magnificent run, steadily climbing and holding well above $4,400 an ounce. It's moving like a traditional asset during uncertain times, absorbing capital. But silver is behaving differently. Silver isn't just rising steadily, it's surging rapidly. This kind of explosive upward movement in a commodity only happens when the simple dynamics of supply and demand are broken, meaning supply can no longer keep up with real physical demand. And that brings us to the core of the issue, the revolutionary shift from paper trading to physical pricing. For decades, the global price of silver has been dictated by financial contracts. The paper silver traded primarily in places like New York. Think about how silver is traded in New York. It's mostly futures contracts. These are agreements that rarely require the physical metal to change hands. You buy a contract, you sell a contract, and the metal often stays locked up in a vault somewhere, or sometimes it doesn't even exist yet. It's a financial game. Now, contrast that with the market in Shanghai. In Shanghai, silver is traded fundamentally as physical metal. When you buy silver there, you expect to get the physical bars, the actual commodity. Historically, these two markets were linked by a powerful force, arbitrage. If silver was cheap in New York and expensive in Shanghai, a smart trader would immediately buy the cheap paper contract in New York, demand physical delivery, ship it to China, and sell it at the higher Shanghai price. This activity would continue until the price is equalized globally. That's how a unified global price is supposed to work. But right now, that mechanism is utterly broken. The price difference, the premium for physical silver in Shanghai, is astronomical compared to the paper price we see quoted in New York. And the arbitrage opportunity is sitting right there, glaring at the market. Why can't traders take advantage of this massive price difference? Because physical silver is incredibly hard to move right now. It's not like moving money with a wire transfer. The constraints are physical and logistical. We're talking about limitations in the refineries that turn raw ore into usable bars. We're talking about constraints in the high security vaults that store the metal. And perhaps most critically, constraints in the global shipping networks, which are already strained and highly regulated when dealing with precious metals. These constraints mean the metal cannot flow freely from where the paper contract says it is to where the real physical demand actually is. The pipeline is jammed, and this changes everything. When the movement of physical goods is constrained, the paper market loses its tether to reality. The financial pricing in New York is becoming increasingly meaningless because the price setter is no longer the promise of delivery. It is the reality of physical availability. The physical metal, the silver you can actually hold in your hand, is now setting the price, independent of the financial contracts. This situation reveals a deep vulnerability in the supply chain and a massive underestimation of industrial and investment demand for actual silver. Silver isn't just an investment asset. It is critical for solar panels, electronics, and countless high-tech applications. When those industries demand metal, they don't want a futures contract. They need the actual physical commodity. So when you see silver prices soaring past $100 an ounce, remember this. It's not just excitement. It's the market screaming that paper contracts are failing to deliver physical reality. And until those logistical constraints are resolved, until silver can flow freely again, the physical price will continue to dominate and push higher. This is a fundamental repricing of silver based on hard assets, not financial promises. What do you think? Are these new structural changes permanent, or will arbitrage eventually win out? Let me know your thoughts in the comments below. Don't forget to hit that like button and subscribe for more deep dives into the markets. Thanks for watching, and I'll see you next time. What if I told you that the world is quietly running out of one of its most essential resources? Not oil, not copper, but silver. For decades, silver has been the bedrock of countless industries. Yet its supply chain is facing a perfect storm of unsustainable demand and constrained production. And this isn't just about a price spike. It's about the physical availability of the metal needed to power the 21st century. This is a story of a silent, growing global deficit, hidden inventories, and geopolitical maneuvering. We're going to dive deep into the numbers, explore exactly where all the silver is going, and uncover why, despite record demand, almost none of it is ever coming back. Let's start with the hard numbers. The global silver market is currently in a deep structural deficit. Global mining operations collectively pull about 32,000 tons of silver out of the earth every single year. That sounds like a massive amount, right? Well, compare that to the global consumption rate. The world uses about 36,000 tons of silver annually. Think about what that means. Every year, we are consuming roughly 4,000 tons more silver than we are producing. This isn't a temporary blip caused by a pandemic or a recession. This is a sustained structural imbalance. To cover that 4,000-ton gap, we have to draw down existing above-ground stockpiles. And those stockpiles, once robust, are rapidly disappearing. But why is the demand so incredibly high right now? The narrative around silver used to be dominated by jewelry and coinage. While those sectors still matter, they are now secondary players. Today, silver is fundamentally an industrial metal, the critical ingredient in the technologies shaping our future. Roughly 60% of all silver mined today goes into high-tech industrial applications. Let's break down the 5 biggest consumers because these are the areas that are completely non-negotiable and only expanding. First, solar panels. Silver is the backbone of photovoltaic technology. It's used in the conductive pastes that transport electricity from the silicon cells. As the world pushes toward aggressive net zero and renewable energy goals, solar capacity is exploding, and with it, the demand for silver. Newer, more efficient solar cells often require more silver per unit, not less. Second, electric vehicles, or EVs. An EV uses significantly more silver than a traditional internal combustion engine car. Why? Because silver is essential in dozens of connections, switches, fuses, and control units where high conductivity and reliability are paramount. As the transition to electric vehicles accelerates globally, particularly in major markets like China, Europe, and the US, this demand sink is only getting bigger. Third, the massive build-out of 5G infrastructure and data centers. High-speed data transmission requires incredibly low resistance and high reliability connections. Silver is perfect for this. Every new tower, every expanding data center, and every piece of networking equipment sucks up more of this precious metal. Fourth, artificial intelligence hardware. AI and machine learning require staggering amounts of computing power, demanding specialized, high-performance processors and motherboards. Guess what material provides the best thermal and electrical conductivity for these cutting-edge components? Silver. As AI expands from the cloud to the edge, into devices and sensors globally, the industrial requirements grow exponentially. Finally, medical devices and general electronics. Think about life-saving medical equipment, high-end consumer electronics, and complex industrial sensors. Silver is crucial in these applications because of its unique combination of conductivity and antimicrobial properties. So we have this massive, non-stop industrial demand driven by 5 megatrends: green energy, electrification, connectivity, AI, and advanced healthcare. But here is the key factor that makes silver AES supply crisis unique compared to other metals like gold or copper: its use profile. Once gold is used in a jewelry piece or even in minor electronics, it's virtually always economical to recycle it. Gold is rarely truly consumed. Silver, however, is destroyed by use. When silver goes into a solar cell, a tiny switch in a car, or the conductive paste of a circuit board, it's often dispersed in such small quantities, or chemically integrated in such a way, that recovering it is either technologically impractical or simply too expensive to be economically viable. The recycling infrastructure for silver in electronics is woefully inadequate compared to the speed at which it is being consumed. Once that solar panel is installed, or that EV leaves the factory, that silver is gone from the market, locked away for the next 20 to 30 years or more. This lack of meaningful recycling volume means that the mining industry is constantly battling to keep up with permanent consumption. It's like filling a leaky bathtub where the drain keeps getting bigger. Now, let's inject a layer of critical geopolitics into this supply picture: China. China is not just the world's largest consumer of silver due to its massive manufacturing base, it's also a major player in silver production and trade. In recent years, Beijing has implemented significant restrictions on the export of many critical industrial materials, and silver is squarely on that list. By restricting silver exports, China is effectively prioritizing its own domestic industrial needs: its solar panel manufacturers, its EV producers, and its 5G and AI hardware developers. This action is designed to secure their national supply chains. The immediate consequence of this policy is a stark divergence in pricing. If you look at the Shanghai Futures Exchange, you consistently see silver prices trading at a significant premium compared to prices in New York or London. This spread isn't driven by arbitrage opportunities. It's driven by the physical reality of scarcity. The silver that is freely available for delivery in the West is functionally separate from the silver that is desperately needed and tightly controlled within the Asian manufacturing hub. The global market, therefore, is fractured. The paper inventory numbers might look acceptable, but the actual usable industrial supply is extremely tight. This brings us to the final and perhaps most confusing piece of the puzzle: the massive stockpiling happening in Western financial centers. In the US and Europe, we have seen enormous quantities of silver move into the vaults of major commodity exchanges like the COMEX. Before recent key political events, for example, over 125 million ounces of silver were reported to be stockpiled in exchange vaults. On paper, this makes the inventory numbers look high. Analysts often point to these figures and say, "There's no shortage, look at the vaults." But there is a critical distinction here, that silver is not moving into factories. It is locked away. This silver is held as a financial asset. It is being warehoused by investors, institutions, and perhaps even large-scale speculators as a hedge against inflation, currency devaluation, or geopolitical instability. It is held under financial contracts, often collateralized, and intended purely as a store of value. It is not available for sale to a factory needing to produce solar cells or a manufacturer needing to build medical equipment. So, while inventories in financial vaults may look superficially high, this convergence of factors paints a clear picture. The silver deficit is real, it is structural, and it is accelerating. As the world pushes harder into electrification and AI, the physical pressure on silver supply will only intensify. This makes silver not just a precious metal, but arguably the most critical industrial commodity currently facing a long-term supply crunch. If you found this breakdown of the silver supply crisis informative, please hit that like button and subscribe for more deep dives into the resources powering our future. Thanks for watching. Hey everyone, and welcome back to the channel. Today, we need to talk about silver. Specifically, we need to talk about why the mainstream narrative around silver is completely missing the biggest story of the decade. If you think silver is just a shiny metal that people buy for coins and bars, you are missing the industrial revolution that is happening right now. And this revolution is poised to drive silver prices to levels that most analysts currently deem impossible. We're not talking about minor volatility here. We're talking about a fundamental structural shift in the silver market that is being driven by industrial demand, not just retail sentiment. When we look at silver, many people focus on the noise: inflation hedge, geopolitical risk, or the latest coin shortage at the local dealer. Those things are interesting, but they are distractions from the true, overwhelming force shaping silver's future, its indispensable role in the modern economy. Let's tackle the most common myth head on. The myth is that industry can simply replace silver with cheaper alternatives when the price goes up. This argument pops up every single time silver gains momentum, and frankly, it demonstrates a complete misunderstanding of material science and corporate economics. Yes, in niche applications, replacement is possible, but in the critical high-volume sectors, like solar, electric vehicles, and high-speed electronics, silver is irreplaceable. Why? It comes down to physics. Silver possesses the highest electrical and thermal conductivity of any known metal. Nothing else even comes close. When you're designing a solar panel that needs to capture and convert every possible electron for 25 years, or an electric vehicle that relies on ultra-efficient, high-current connections to maximize battery range, or the next generation of 5G chips where speed is paramount, you cannot compromise on conductivity. If a company tries to substitute silver for a cheaper metal like copper, nickel, or aluminum in these critical junctions, they immediately run into a trade-off: reduced efficiency. That reduction in efficiency costs the company far more in performance degradation or warranty claims and reduced product lifespan than the fraction of a cent they saved on silver content. Cutting silver to save money is a short-term, penny-wise, pound-foolish decision. We are seeing companies learn this the hard way, which is why the actual trend in solar and EV manufacturing is toward maintaining or even slightly increasing silver loading to boost performance and reliability. So let's step back and look at the market structure. We often hear about retail shortages, the difficulty in finding physical coins or bars. While these retail shortages are real and indicative of strong public demand, they are merely a ripple compared to the tidal wave forming in the industrial sector. The true story is the growing industrial competition for physical metal. Global industrial consumption of silver is enormous and growing exponentially, primarily driven by the green energy transition. Think about the sheer scale. Billions of solar panels, millions of EVs, and an endless stream of complex electronics and medical devices. All these require physical silver, which must be mined, refined, and delivered. This is where the structure of the silver market gets incredibly stressed. The supply side is relatively inelastic. Mines take years to develop, and existing production is struggling to keep up. Meanwhile, the demand side is aggressive and urgent. What happens when a massive fabrication plant needs a steady, reliable supply of silver powder or pellets to keep their assembly lines running? They cannot rely on the volatile paper-driven futures market to guarantee delivery. They need the physical metal. And increasingly, large industrial consumers are bypassing the traditional routes and are beginning to pay significant premiums to secure contracts directly with refiners and mines. This is the critical inflection point. As industrial users start paying substantial premiums for physical silver to ensure their supply chain integrity, it creates a massive disconnect between the low speculative price traded on exchanges, the paper price, and the high supply-driven price paid for actual deliverable metal, the physical price. This is not conjecture. We are already seeing this phenomenon play out in specific regional markets. Look at the dynamics in Asia, particularly the Shanghai Futures Exchange. We frequently see silver trading at a material premium over the prices quoted in London or New York. Why? Because Shanghai is heavily focused on delivery and physical settlement, aligning supply and demand for the industrial heartland of the world. The paper market is forced to reflect the underlying physical reality far more closely. Historically, the Western exchanges have allowed the paper price to dictate terms, using leverage and derivatives to suppress volatility. But when the world's largest consumers start paying over the odds for physical metal, the paper market loses its power. It can no longer ignore the physical tightness. The paper price must eventually chase the physical reality, not the other way around. This market correction is inevitable when industrial demand outstrips available supply, and we are on the cusp of that happening now. When these industrial giants, the makers of solar cells and EV batteries, become aggressive bidders for physical metal, the price impact is exponential. They are not sensitive to a $5 or $10 increase in silver price. They are sensitive to production stoppage. They will pay whatever they need to keep the lines running, and that competitive bidding directly drives up the physical spot price for everyone. This analysis is why established conservative financial institutions are making such stunning projections for silver. Consider the analysis from institutions like the London Bullion Market Association, which is comprised of some of the most serious players in the global precious metals industry. They are not prone to hyperbole or speculative fantasy, yet their long-term forecasts have projected silver to average near $100 per ounce by 2026. Think about what that projection implies. It means they see the current structural deficit, the gap between supply and demand, widening dramatically, forcing a massive price adjustment to incentivize new supply and potentially destroy some marginal demand. But even a projection like $100 might be conservative if the physical tightness continues unabated. If these industrial shortages intensify, where refiners simply cannot meet the immediate demands of their largest clients, we could see sharp, violent price spikes. In a scenario of sustained physical deficit, where industrial users are in a bidding war for metal, prices spiking to $120, $150, or even higher are absolutely possible. This is not driven by fear or speculation. It's driven by the simple necessity of industrial production. The silver story isn't about collecting coins. It's about the backbone of the modern green tech economy being built on a metal that is fundamentally scarce. Every time you see a solar panel, every time you drive an electric car, every time you use a high-speed device, you are looking at industrial demand for silver. So if you're looking at silver, shift your focus away from the minor retail fluctuations and look at the industrial usage figures. Look at the mounting deficits in the physical market. The industrial demand is the engine. And when that engine starts running hot, it will force the paper prices to catch up to the true physical value of silver. This structural reset is the biggest opportunity in the precious metals space right now, and it's one that the paper market simply cannot suppress forever. Don't miss the forest for the trees. The physical shortage is the story, and the industrial giants are the main characters driving the price appreciation. If you found this deep dive into the industrial mechanics of silver valuable, please hit that like button. Subscribe for more content that cuts through the noise, and let me know in the comments. What do you think is the true, irreplaceable industrial use of silver? Thanks for watching, and I'll see you in the next video.